Good evening, everyone. My name is Jerry D'Ambrosio, and it's my pleasure to deliver this week's special presentation. VectorVest stop price is a 13-week moving average that is adjusted for a company's fundamentals. We raise the stop for poor fundamentals and lower it if they're good. The stop is your last line of defense, and you never want to ignore price falling below it. There are many different ways to exit a position before price falls below our stop price, and tonight we will demonstrate one of them. The first thing we need to understand, though, is that trade implementation begins with good risk management. Good risk management will ensure your survival in this game. If you don't have a good risk management strategy, losses will keep building up, your portfolio will unravel, and you'll wind up with no more money to invest. So what we're going to talk about here tonight is how to size each position and set the proper stop loss. And the equation that we're looking at here solves for our stop loss percent. Dr. DeLito has talked about this equation. He's also talked about the 1 to 2% rule a number of times in the VectorVest views. He's written about it. And it goes like this. Don't risk any more than 1% of your overall portfolio value on any single position. So with 10 positions and $100,000, and 100% of that invested, we should be using a 10% stop loss. 1% of $100,000 is $1,000, so we don't want to risk or lose any more than $1,000 on any one position. And I'm not saying that we invest $1,000 in each of our 10 positions. We don't want to risk or lose any more than $1,000 on each position. So again, if we have 10 positions, $1,000 of a $10,000 investment gives us a 10% stop loss. And you can adjust this and recalculate it based on how much money you have to invest and how many stocks you want to hold. For example, if we were still, again, using a $100,000 portfolio, but we only wanted to hold 5 stocks, we would put $20,000 into each position. We still don't want to risk any more than $1,000 in any single position. Therefore, that brings our stop loss to a 5% stop loss. So for the purposes here, we're going to assume a $100,000 portfolio, 10 positions, and we're going to use a 10% stop loss. Now the question becomes, does a 10% stop loss make sense for every stock that we hold in our portfolio? Here are 2 stocks, Stock A and Stock B. Stock A moves from the bottom left to the upper right in a nice, methodical, smooth manner. Not at all very volatile, higher highs and higher lows. Stock B also moves up from bottom left to upper right, but it is quite a bit more volatile. It gets there eventually, but it's a much bumpier ride along the way. So again, does a 10% stop with $10,000 invested make sense for both stocks? Well, let's take a look. The indicator that we're going to use here tonight is an indicator called Average True Range, also known as ATR. Just a quick description, it was developed by Wells Wilder. Wells Wilder also developed the RSI, Relative Strength Index indicator, very popular and effective indicator that identifies overbought or oversold price situations. ATR was designed to measure volatility, and it is a moving average of a combination of recent high, low, and closing prices. I'm not going to get into the calculation or the formula of it. If you want to Google Average True Range and find out a little bit more about it, how it's calculated, you can do that. What I want to talk about today, though, is the application of the indicator, how to use it. And we are going to be using the industry standard 14-day ATR. We're going to be looking at daily price charts. So it's a 14-day look-back period. And again, that is the industry standard. It can be used as a way to exit a trade. We are going to look at that application of the indicator. And it doesn't matter how the entry was made. We're not going to talk much today about entry. You could have entered into the trade or the position off of a support retracement, for example, or a moving average crossover, or a channel breakout, or a bullish candlestick reversal pattern. No matter how the entry was made, you can use the average true range to help manage that trade and determine when to exit. We're also going to be using it to help us with position sizing and setting the right stop loss. So for example, we have Etsy. I'm not saying let's go out and buy Etsy right now. Up until yesterday, the market was getting crushed, right? Tuesday and Wednesday, severe down days. We have a confirmed down situation. The MTI is below 1. Buy-to-sell ratio is below 1. So I'm not saying let's go out and buy Etsy today or Monday. This here is an exercise in how to use the average true range to size your position correctly and set your initial stop loss. So at the time you take the trade, you look at the current ATR reading. So first off, we're looking at a price of $159.34. Now that was the closing price as of Wednesday, May 12th. Let's just assume that is our cost basis. That's our entry price. At the time you take the trade, you look at the current reading of the ATR. The 14-day ATR as of May 12th was $11.36. A rule of thumb or common application is to multiply the ATR by 2 to determine a reasonable stop loss. So we do that. We multiply ATR times 2. That gives us $22.72. You place a stop loss at a level twice the ATR below your entry price. So that gives us an initial risk of $136.62. That's where we set our initial stop loss. If the trade goes the other way right away, we are going to allow 2 ATR to help us exit out of the trade. However, that will result in a 14.25% loss. So I'll pose the question again. Does a 10% stop loss with $10,000 invested into Etsy make sense? Well, it doesn't if you want to continue to abide by the 1% rule. If we were to allow the stock to fall 14.25% and invest $10,000 into it, we would have a max loss of about $1,425. Well, that's more than the $1,000 that we're willing to risk or lose on this trade. So what do? We have to adjust our position size. We have to buy less shares. We have to put less money into the trade in order to abide by the 1% rule. Therefore, we put $7,018 into the trade. Now, how did I come up with that number? I take $1,000, that's our initial risk. I divide it by the percent loss, which is 14.25%. That gives us an initial investment of $7,018. Therefore, if we happen to lose the entire 14.25% max loss with a $7,018 investment, we'll still only lose 1% of our overall portfolio value on this trade. Let's take a look at Ford. Again, this is not a recommendation to buy Ford. This is an exercise in how to use ATR to calculate your initial stop loss and to size the position correctly based on the volatility of the individual stock. As of the close of May 12th, Ford closed at $11.33. 1 ATR is 36 cents. So again, a rule of thumb is to multiply ATR by 2. That gives us a 72-cent initial risk. Subtract 72 cents from our cost basis. Again, we're going to assume $11.33 as our cost basis. That gives us our stop loss at $10.61. Now that only will result in a max loss of 6.35%. So does it make sense to invest $10,000 into Ford given the current volatility of the stock? The answer is yes. And the answer also is we can actually leverage up a little bit. We can invest more money into the stock. So $15,749 investment with a max loss of 6.35%, still we would only lose $1,000 on the trade. Now I know we generally will say don't put any more money into one position than the other, because if that one position becomes your biggest loser, your portfolio will struggle. But if you continue to abide by the 1% rule, you can do that. You can leverage up. You can invest more money into a single position, given the current volatility of the stock, as long as your initial risk is no more than the 1% of your overall portfolio value. Everybody following me? Here's TMST, Timken Steel. As of the close of May 13th, the stock price closed at $14.34. One ATR is $1.07. We'll round that up. We multiply that times 2. That gives us an ATR times 2 of $2.14. That is our initial risk. We subtract that from our cost basis. Gives us our stop loss at $12.20. Well, what is $2.14 of our cost basis of $14.34? Well, that results in almost a 15% max loss, 14.92%. If we were to invest $10,000 into this trade, our max loss could be almost $1,500. It's not where we want to be. Remember, we want to be as close to 1%, if not at 1% risk as we can. So what do? We adjust our position size. You take your initial risk, $1,000, divided by 14.92%. That gives us an initial investment of $6,702. And this assumes max loss, by the way. What we're going to talk about next is how to use 2ATR to help us manage a winning trade. This exercise here is how to calculate your initial stop loss and size the position correctly according to the volatility of the individual position. So that if we invest $6,702 and we happen to lose the max of 14.92%, that will only result in a $1,000 loss, keeping in line with our 1% risk. Now here's Facebook. Now we're going to talk about how to use ATR to manage a winning trade. And what it becomes now is a trailing stop. And again, I'm not going to talk about entry here. For example, though, I actually bought Facebook in our swing trading coaching group a few weeks ago, and I bought it right in this area here. It was a bullish Harami follow through, also a retracement off of this recent swing high. It was a perfect setup, and I purchased the stock right on this doji day here after it followed through off of the bullish Harami. They released earnings a couple of days later. Facebook has a wonderful track record, very consistent and predictable when it comes to their earnings reports. I was not worried about if they were going to miss not only the street expectations, but their forecasts as well. You can see the stock gapped up, hit a high of $331.81. So what the average true range is now, or what it becomes, is a trailing stop. And we're still going to use the ATR times 2. Now on that day, the one ATR was $7.37. I know here it says $8.28, but that's as of the hard right edge. On this day here, the ATR was $7.38. We multiply that times 2. That gives us an ATR times 2 of $14.76. That becomes our trailing stop loss. If the stock continues to rise, which it didn't, but as the stock continues to rise, that trail also adjusts, and it continues to adjust as the stock goes higher. In this case, that was the highest high that the stock price reached since we purchased the trade. So $14.76 minus the high of $331.81 gives us a stop loss of $317.05. Really nice way to capture profits as volatility begins to pick up. Now, same stock, we're still looking at Facebook, and what I applied here now is our stop price. Remember, our stop price is a 13-week moving average. Our stop price is a fantastic guide to keep a prudent or conservative investor in the stock a little longer. Notice over this 1-year time period, it looks like that the price of the stock only dipped below the stop price once, giving it a sell rating. So if you're more of a prudent investor, a longer-term investor, the stop price is a wonderful tool to use to keep you in the trade longer. If you're a little bit more of an aggressive trader or more active trader, there are other ways to manage positions, to manage trades, and I'm demonstrating one of them. ATR is a fantastic tool to measure volatility. So once volatility starts to pick up and price continues to rise, the ATR will allow you to lock in gains not too far off of the actual high. Here's United. We're looking at the hard right edge here. Recently, the stock hit a high of $425.98. 2 ATR on that day was $11.52. So since $425.98 was the highest price achieved since you purchased it, and you may have purchased it somewhere in this area here, $11.52 becomes your trailing stop loss. That got us out of the trade the very next day. So you subtract $11.52 from the high of $425.98. That gives us a stop loss of $414.46. As of a couple of days ago, the stock was at $405.37. Using our stop price, and if you're more of a prudent to conservative investor, and you have to understand who you are as an investor and what type of portfolio you're managing, it's about defining objectives. You would still be in this trade or this investment. The stock has a buy rating. It's above its stop price. There's a bit of volatility here over the last year, but prices stayed above the stop price the entire time, allowing the prudent or conservative investors to stay in the position. Traders will look to take advantage of turning points for both buying and selling, right? And the ATR helps us do that. Once volatility begins to pick up, ATR will allow us to capture profits. Here's Tractor Supply. Good looking stock. Bottom left to upper right during this time frame here. Higher highs and higher lows. So let's take a look at this area here on the left-hand side. Stock hit a high of 160.83. 2 ATR allowed us to exit at 153.23, about a week or so off of that actual high, and you could see price continue to fall after our 2 ATR stop loss bounced us out of the trade. Stock continued to fall. Nice little one white soldier reversal pattern here. So if you're a trader, good signal to get back into the trade. Stock hit another new high of $173.37. 2 ATR, and again, since that was the highest price achieved since we purchased it, the stock price fell off of that high of 173.37. 2 ATR bounced us out at 162.59. You can see the stock did continue to fall after that. Another one white soldier reversal pattern here, allowing you to get back in right off of that higher swing low. And then recently, and nowhere in this area here, by the way, did 2 ATR bounce us out of this trade. If we happen to enter back in off of this one white soldier pattern, here was the highest point that the stock reached if you entered during this run up. This pullback here did not result in us exiting the trade. 2 ATR did not bounce us out of this trade here. 2 ATR would have got us out at $191.51. And you can see the stock closed yesterday at $186.54. Using our stop price, if you're prudent or conservative, you would have stayed in the position the entire time. So folks, I go back to define your objectives. Who are you as an individual investor? Are you a trader? Are you an investor? Or are you both? Are you managing a swing trading short-term portfolio, or are you managing a retirement portfolio? If you're managing a retirement portfolio, I don't think the ATR would be a reasonable indicator to use to manage that type of portfolio. You don't want to trade in and out more actively. You want to stay in the position, really as long as possible, as long as the trend continues. And in this case, we're going to use our stop price. As long as the price of the stock remains above its stop price, stock's either going to have a buy or a hold rating. Your retirement portfolio, you're able to stay in that investment. I want to thank everybody for joining me here today. And what I want to talk to you guys now about is a brand new course, bluntly called When to Sell. This all-new course was developed by an all-star cast of Dr. David Paul, Stan Heller, Steve Chappell, and myself to teach you the best techniques to know when to sell and to bank your profits before they disappear. We've never created a course before where we had 4 instructors teaching the course. So let's go over the agenda here really quick. Module number 1, setting yourself up for success. We're going to talk more about define your objectives and make sure you understand the types of stocks that belong in the different types of portfolios that you manage. We'll talk about market timing, more on risk management and position sizing. Stan Heller. Stan is our VectorVest Canada consultant. He's going to teach you about using moving averages as stop losses. He'll teach you the Guppy trading system, everything you need to know and how to use the VectorVest stop price, short and long-term exits, and a 40-day moving average on relative timing. You might be wondering, well, is this a trader's course or is this an investor's course? This is a course for everybody. In a lot of the webinars that we do, we always ask the question, what's the most difficult part? What has been the most difficult part for trading or investing for you over the years? And the overwhelming response is, when do I exit? When do I sell? And this course was developed because we listen. We listen to those concerns and we developed this course. This is a long time coming. We developed this course for both the trader and the investor to understand how to manage risk and set the proper stop loss for every trade that you place. Module 3, I'll come back and teach you about different technical indicators to pinpoint exits. And we will be looking at short and long-term exits, daily and weekly charts. I'll talk about the MACD and more on average true range. David's going to teach module 4, and it's about stop loss and price targets using the Fibonacci sequence. Another request by our clients is, you have the Fibonacci in the program. Well, how about teaching us about it? So we listen, and we decided to add the Fibonacci sequence to this course, and there's no better person to teach you about the Fibonacci sequence than Dr. David Paul. Number 5, trailing stops to navigate favorable price trends. Steve's going to teach about just different types of trailing stops. Again, short and long-term guidance and a lot on the Profit Locker Pro. And then the 4 of us will come together in Module 6 and make sure you guys leave with a plan. And the plan really revolves around matching your stop loss to your objectives. Those are live modules. This is a brand new course, so there's nothing in the VectorVest University yet. Those modules will be taught live. We're also going to be doing 6 live mastery support sessions. These are great. They help you implement what you learned during the module. We'll take a look at what you're doing. We'll answer questions, and we'll really hold your hand through this entire process. If you don't have VectorVest 7 Intraday, which is our 15-minute delayed data, we're going to give it to you as part of the course. We're also going to provide ProTrader, which is a technical analysis scanning tool. Now, the course is available in the VectorVest University. The regular price is $995, but this weekend only, we want to offer a special price of only $495, but you have to register before Monday at 5 p.m. Eastern Time. Here are the dates for the live modules. They'll begin on May 26th, Wednesdays at noon. And the live mastery sessions will also be at noon. And here are the dates for those live sessions. You can go to VectorVest.com/sell. When you go to VectorVest.com/sell, you can not only register, but if you scroll down to the bottom, you'll see the live dates as well for the modules and the mastery sessions. And those dates will also be provided in the email that you receive after you register. Folks, I really look forward to this course on behalf of Steve, Stan, and David. We look forward to working with you. And if you're someone that has had an issue with setting the right stop loss and knowing exactly when to exit a trade, this is the course for you. Have a great evening, everyone. Look forward to working with you.